Hi everyone, welcome back to Football Finance Professionals. Today we are talking about one of the most controversial and biggest topics to have hit the headlines in the world of football finance in recent times, and that's Everton's 10-point deduction from the Premier League for having breached FFP, or Profitability and Sustainability regulations as they are known in the Premier League handbook. This is an unprecedented decision by the Premier League. It has never punished a Premier League club before for breaching profitability and sustainability. It has previously done so for going into administration or other matters, but this is purely a financial matter, and therefore it sets the bar for other misdemeanors in the future. 10 points is the biggest deduction that the Premier League has ever given to a club, and it's done so via an independent commission. In this video, we are going to unpick some of the finance-related matters within that case, go into the detail when it comes to the Independent Commission's documentation, and try to understand what Everton may have been able to do differently, had they been able to turn the clock back, and where they may have made some mistakes. Without a doubt, this is the hottest topic in football finance at present, and potentially even in sports business overall. So please feel free to stay tuned. If you like the video, hit like, and we'll be sharing our expertise, having worked at the highest level of the football industry in finance, to help you understand the issues from Everton's perspective. On this channel, Football Finance Professionals, we want to help you to understand finance topics using the medium of football. And for us, the value that we can provide is twofold. We're using football as a medium to understand a vital topic and life skill, as well as allowing you to understand the football finance landscape. Some of the intricacies of the report that's been published by the Premier League Commission are accounting principles and quite technical, and that's how I managed to forge my way into the industry. So I'm hoping that I can shed some light on what's going on in this particular case. Please, if you'd like to support the channel, hit subscribe, leave a comment below, ask a question, like and share the video. So let's begin. Before we get started, we really need to understand the legal entity structure, which is a really sound basis of understanding what goes on within any organisation before you try to do any analysis. On top of that, it would be helpful to understand the financial background of the situation that Everton finds itself in. And for that, feel free to click the link above to review our previous video on the topic of Everton's finances and whether the 777 takeover was something that was going to save the day. We also need to understand the financial regulatory landscape in which Everton sits. And once we've been able to do that, we can dive into the detail of the Independent Commission's reporting. Everton Football Club Company Limited is both the holding company and the main trading entity of the wider Everton Group. This group will include subsidiaries that hold assets such as Goodison Park, the stadium development at Bramley Moor Dock, Everton Investments Limited, and the women's team, each of which are separate legal entities and all consolidated as part of the Everton Group, headed up by Everton Football Club Limited. The ultimate beneficial owner is Farhad Mashiri via an Isle of Man registered company named Blue Heaven Holdings Limited and ultimately Blue Horizon Investments Limited. Blue Heaven Holdings Limited holds 94.1% of the share capital of the football club, with the remaining 5.9% being spread across various investors, some of which only hold one share and some hold multiple. The group structure will have been set up for a variety of reasons. Usually tax planning, forward thinking, potentially regulatory requirements and other matters are considered when setting up a new subsidiary, sister company, holding company or wider group structure. Everton Stadium Development Company Limited is the legal entity that's holding all of the costs, most of which are being capitalised in relation to the Bramley Moor Dock development. This is usually done to be able to encapsulate the costs in a separate legal entity, primarily with a view to financing that project. Security for such a development could be separate to any other assets. Therefore, a separate legal structure for the stadium development would allow freedom for the rest of the Everton Group and reduce the risk. The topic of the Everton Stadium development is key to this whole topic and something that we'll revisit later in the video. From reading the Independent Commission's report, it seems that the Everton Group, including the subsidiaries and the top company being Everton Football Club Company Limited, is being submitted to the Premier League as part of their profitability and sustainability calculations. This is the first point that we'd like to understand, because if we look in the Premier League handbook, the definition of a club with a capital C is an association football club in membership of the league. The handbook goes on further to define the definition of a club and expands that definition for certain elements of the handbook. Now, why is this important? Well, the consolidated results for Everton are going to be different to the single legal entity of Everton Football Club Company Limited. Primarily, the costs relating to the Everton Stadium Development Company Limited are separate to the trading company, which is the football club. So if the rules are defining, as it does for certain sections or certain paragraphs within the handbook, which are not club finance related sections, that the definition of a club is expanded to include associated undertakings, fellow subsidiary undertakings, group undertakings, or parent undertakings of such a club. My question is, why are Everton submitting financial results to the Premier League that are wider than the club? That's something that only Everton and the Premier League are able to answer. Given my interpretation of what's written in the handbook, there is a potential challenge there for Everton to say that the club financial statements should be under review as opposed to the group. Section E is the section of the handbook that governs club finances. And this is a section that contains the profitability and sustainability rules. In Section E, it quite clearly states that the Premier League is able to ask for financial statements that go beyond the club. And if the club believes that it's appropriate, it should submit group accounts on behalf of the wider group to the Premier League. So either they can be requested or submitted by the club itself. However, the profitability and sustainability rules within the handbook specifies the club with a capital C, which references then back to the definitions in the front part of the Premier League handbook, which is quite explicit to expand the definition of a club for certain sections of the handbook which do not include profitability and sustainability. Now, does this mean that Everton could or should have submitted a different set of financial results to the Premier League? Ultimately, what has been submitted is what the Premier League are going to accept. This is a specific legal matter and not one for finance professionals to necessarily opine upon, but definitely one for the lawyers to get involved in. Nobody could foresee, either in the Premier League or at the club, this issue from happening. And it's happened for a variety of reasons which we'll go into further in the video. But ultimately, it's up to the club and the league to be able to interpret these rules. And our view is that if the definition of a club for the purposes of profitability and sustainability is wider than the club legal entity, then perhaps that should be specified in the club definition, just to make it clear. This is a key point because the costs of the Stadium Development Company in 2022 included £20 million of interest expense that was recharged from the football club to the Stadium Development Company for interest costs that have been incurred directly in relation to the stadium development. Now, from a single entity point of view, with no consolidation, if Everton Football Club was submitting its accounts, it would have £20 million of upside from an interest perspective in comparison to the consolidated set. And given that the breach was quantified at 19.5 million, this may turn out to be a key point. Having said that, it's something for the club to pick up with the Premier League, and it's likely that that's too late to argue. Even if it was able to remove the Stadium Development Company from the submission, it could then be questioned as to whether the £20 million was a fair value transaction between two related parties. That's a whole different can of worms that could be opened. It must be noted that in the Commission's decision, Denise Barrett-Baxendale, the former CEO of Everton Football Club, did request that the reporting perimeter, as quoted in the Commission's documentation, was adjusted to remove Everton Stadium Development Company Limited. The definition of a reporting perimeter is actually something that doesn't exist in the Premier League handbook as far as we can see at least. And again, there may be some supporting documentation that goes beyond the Premier League handbook that defines a reporting perimeter. The reporting perimeter is something that is defined by UEFA, financial fair play and club licensing and club monitoring. That concept looks to have been borrowed by the Premier League in order to be able to apply that, potentially in agreement with the clubs, so that that concept is applied across the rest of the Premier League. But from our interpretation of the rules, it seems to read slightly differently. Beyond the legal entity of the structure, what Everton need to be able to comply with is the profitability and sustainability rules, which states that over a 3-year period, £105 million of adjusted aggregated earnings or losses before tax, in this case, would be allowable within the rules. Put in plain English, you're allowed to lose £105 million over a 3-year period once you've made adjustments for certain investments that are allowed or encouraged by the rules. That equates to, on average, a £35 million loss every year. That compares to UEFA's rules, which are now set at €60 million over a 3-year period, previously €30 million, and before that €45 million. So quite generous in comparison to UEFA. This partly explains why, in the past, it's been quite difficult for Premier League clubs to get anywhere near these limits. The Premier League is the most equitable and the highest value league in the world when it comes to broadcasting rights. And therefore being able to spend all of that money, plus matchday income, player trading income and commercial revenue, is quite difficult to get to the point where you're losing £35 million every year. In Everton's case, and in other cases that span this period, we would actually be looking at a 4-year period because of COVID, which takes the 2019-20 season and the 2020-21 season and amalgamates the two, taking the average adjusted earnings figure for those two periods, making one period that goes into a 4-year reporting period for profitability and sustainability. COVID is a large part of Everton's argument. It's something that hit the whole industry and definitely hit Everton, in their eyes, greater than the rest of the league. The Premier League and UEFA did acknowledge that COVID had a massive impact on the finances of football as a whole, and neither wanted clubs to be punished as a result of a global pandemic. So both organisations, the Premier League and UEFA, relaxed their rules, and the Premier League relaxed their rules even more than UEFA, potentially primarily due to the shareholders being able to vote that change in, and expanded the definition of COVID-related costs in comparison to UEFA to include costs incurred by clubs that are directly attributable to the pandemic. If the club could prove that a cost had been incurred, whether that's player-related or otherwise, and it was directly impacted by the COVID pandemic, it could be adjusted back in the profitability and sustainability calculation. UEFA, on the other hand, only allowed lost revenues, which were also included by the Premier League, which shows that the Premier League again were really lenient in comparison to UEFA when it came to dealing with the COVID pandemic. Over the 4-year period ending 2022, Everton's group accounts showed accumulated losses over that period of £417 million. With the 2 middle years being averaged, we can tailor that back to £287 million before any adjustments. But that sits at £182 million above the £105 million threshold, assuming that £105 million, or at least the excess above £15 million, which is the acceptable loss in the Premier League rules, assuming that is actually underwritten by secure funding from the shareholders. And that's on the cash losses, not necessarily the losses that have been made from an accounting perspective. This is where things get interesting. So Everton, along with all of the other clubs within the Premier League, were able to adjust their financial results, earnings before or losses before tax, to get to their profitability and sustainability calculation for women's costs, youth development expenditure, community expenditure, infrastructure, and for specific years, COVID-19. When all of that's been taken into account by the Commission and by the Premier League initially, it's been concluded that Everton made losses over the 4-year period or 3-year assessment period of £124 million, £19.5 million above the allowable threshold. So what was Everton's argument against the Premier League and that £124.5 million loss to make it compliant? Let's take each one in turn. Before we do, I think it's worth noting that Farhad Moshiri's investment strategy was particularly risky, and that's acknowledged by the Premier League and the Commission. It was extremely risky because the owner decided to invest in the football squad and developing a new stadium at the same time. Both huge levels of expenditure, largely funded by the shareholder, but two expensive projects at once, both needing cash funding. On one hand, the investment should be relievable from an FFP or a profitability and sustainability point of view, being infrastructure, On the other hand, player trading strategies are particularly risky where you do not have a coherent football strategy to go around it. Ultimately, some of the arguments that Everton put forward are down to technical accounting issues. So it should be noted that Everton apply FRS, or Financial Reporting Standard 102, which is a relatively new set of standards that replaced UK generally accepted accounting principles back in 2015. So what are the categories of argument from Everton's point of view? Well, they can be broadly categorised into 5 categories. Quite a lot really when you think about it. These were namely stadium-related costs, being pre-planning, and interest-related costs as 2 subcategories of that first category. Player X and his breach of contract and the club's approach to managing that breach of contract. The stadium naming rights with USM, which is a company owned by Alisher Usmanov, a business partner of Farhad Mashiri. The club's interpretation of the transfer levy and whether that should be classified as youth development expenditure, and COVID-19 costs, which the club said totaled £61 million. So taking all of these factors into account, Everton initially said that their loss before tax that was adjusted and aggregated for the period, including all the mitigating factors, including all of the adjustments that could be made that they believe to be in line with the rules, the loss came to £87 million. That's a substantial reduction from the £287 million that we got to when we averaged out the 2 middle periods. £200 million of adjustments in a 3-year period, largely driven by COVID. The problem from Everton's perspective is that the Premier League were aware of what was going on, aware of the communication between the club and the league and how the club had interpreted the rules, and fundamentally disagreed with certain aspects of them, which we'll go into in just a moment. The other problem is that when Everton had their pre-trial review, they amended their plea from being effectively innocent to guilty, but with a minimal overspend of £7.9 million. Now, was that strategically the right thing to do? On one hand, you said that you had an £87 million loss, and then you concede that that is breaching the rules to try to potentially reduce the penalty. And that didn't seem to go down well with the Premier League. This is where the case seems to get quite complicated. Toing and froing between the club and the Premier League over a period of time where the Premier League is actually being quite generous in its approach to pre-planning costs, for example. A specific issue for Everton, where the club's been initially able to lose £105 million, which is relatively generous in comparison to other leagues. It's also been able to attribute a large amount of value to COVID-19, again in comparison to UEFA rules, much more generous from the Premier League's perspective. And then these pre-planning costs, which are associated to the Bramley-Moore Dock Stadium development. There were substantial costs that were incurred before planning permission was given. And this is where the accounting standards come in. If you cannot prove that there will be probable flows of economic benefits to the entity in relation to the asset under construction, it's not possible to capitalise any costs until you can deem that that will be probable. That's up for interpretation, but planning permission does neatly draw a line between any costs associated prior and post planning permission being granted. So it's not uncommon that pre-planning permission costs are not capitalised, especially if you do not know whether that project is going to go ahead. And given the complexities of the site, being a UNESCO heritage site, then at least in Everton's view and in their auditor's view, it was prudent to expense those costs. Since those costs therefore end up in the profit and loss account, they form part of the profit and loss before tax, and that's the starting point for profitability and sustainability. Therefore, they're in the profitability and sustainability calculation. The Premier League, through communication with Everton and as documented in the Commission's report, were relatively lenient on this point again, allowing for adjustments given certain conditions of compliance to Everton, saying that that pre-planning cost wouldn't be considered as part of the profitability and sustainability calculation. So, assuming that Everton could comply on every other metric, you could effectively discount the pre-planning costs. In order to be able to agree that, Everton and the Premier League entered into an agreement in 2021 to agree on what the conditions were of that specific issue. In Everton's amended case, when they pleaded guilty, they stated that some post-planning interest of £13 million, or just over £13 million, should be adjusted as part of the profitability and sustainability calculation, but The league disagreed because it didn't form part of that 2021 agreement. Capitalising interest is another technical accounting issue, again linked to the construction of an asset. In order to be able to capitalise interest, the borrowing costs need to be directly attributable to a qualifying asset, i.e., as we mentioned earlier, if the stadium development company were to take out external debt that was potentially secured against the stadium, which is what we saw in Tottenham's case, for example, then it could be argued more strongly that those funds were being used and therefore the interest could be capitalised for that particular asset. And if you take that approach, you need to take the approach across all qualifying assets, not just specific assets. It's an accounting policy and one that needs to be decided by the club before any of these matters come to the fore. The problem in Everton's case is that the funding that they got from Rights and Media and Metrobank were for generic purposes, what's described and documented in both the loan agreements and in the commission as working capital facilities, not specific enough to be able to be attributed to the stadium development. The rest of the stadium development was funded by Farhad Moshiri to his credit using interest-free loans. But if interest-bearing loans, whether they're shareholder or external loans, were used to fund the whole project, Everton would have been in a far worse position from a cash perspective, but they would have been potentially able to capitalise the interest costs as part of the development. The second point that Everton were arguing was the transfer levy. So on transfer fees, a 4% levy is charged to each club that's acquiring a football player's registration, which is used to fund the player's pension scheme. Any excess is reinvested back into the youth setup within football. And Everton's argument was that the levy is therefore funding youth football and therefore part of youth development expenditure and could be relieved. The Premier League took the opposite view in that the expenditure wasn't actually the club's to begin with, and it's only the excess beyond the pension scheme contributions that end up going back to youth football. Given the fact that the Premier League decide to invest that, they state that that's not a club expenditure and therefore does not meet the definition of youth development expenditure. To the other points, player X was arrested and therefore in breach of contract, did not play for Everton again, and the losses in relation to that player from the football club's perspective were in the region of £10 million. Due to a breach of contract, Everton felt that they were able to recover those monies from the player, but decided not to do so to try to preserve or maintain the player's mental health. So did the right thing from their perspective, but potentially to the detriment of the club. In Everton's amended plea, they stated that £43.9 million should have been adjusted for COVID-related costs in relation to primarily player Y. And again, the Premier League disagreed that the club actually chose not to sell player Y, who's unnamed in the Commission's report, and therefore it's part of the overall mismanagement of the football strategy and therefore Everton's fault and should not be adjusted. So part of the problem with these rules and the case as we see with Everton is that these rules have never really been tested to this level before. So what we're seeing come out now is a lot of interpretation of the rules as we've mentioned in this video, and we're seeing that the Premier League Commission is willing to punish clubs for these misdemeanours. The final factor that we've not mentioned yet is Ukraine. Alisher Usmanov and his USM company that was due to be the headline sponsor of the stadium that was not yet built. Everton argued that they were about to enter into a partnership agreement with USM, Alisher Usmanov's company, to name the Everton Stadium after his company. That would have been a £200 million deal over 20 years, £10 million per year. There was also talk in the Commission's report of bringing forward that sponsorship deal to be able to compensate the club before the stadium had been developed, which would be very unusual to be able to have a partnership deal for something that doesn't yet exist. And given the relationship between Farhad Moshiri and Alisher Usmanov, I'm sure that would have been captured by the associated party transaction rules within the Premier League's handbook and would have been subject to a fair market value assessment. And the likelihood is that little to none of that value would be attributable to the profitability and sustainability calculation, because the money, even if it was paid, doesn't necessarily mean that revenue should have been recognised. Again, a technical accounting point. Just because cash has changed hands doesn't mean that revenue should be recognised. The Russia and Ukraine war obviously had an impact on that deal, and therefore it wasn't executed. But the Premier League's argument again was that it should have been executed well in advance if it was something that the club were going to be able to secure. So the Premier League came to the conclusion that primarily Everton had overspent on players and the Commission agreed. In the end, stadium-related costs were a contributing factor to go beyond the generous limits of profitability and sustainability, but they did not cause the breach to begin with. The saving grace for Everton is that there is an appeals process, and the 10 points deduction that has already been administered and issued by the Commission could change in the future. It will be interesting to see what Everton's view is in that appeals process and how it pitches its arguments. On the back of that appeals process, I'm sure there'll be further documentation that's being shared by the Premier League and the new Commission that will hear the appeal. But what's the impact on other clubs? Should they be concerned about this change of tone from the Premier League, where we've had a historical period of compliance or the regulations not having any teeth, it could be argued? What does the future hold for profitability and sustainability? That could be in Everton's case or in any other club's case. What does the future hold for Everton? Well, first of all, Everton must go through the appeals process and then must continue to comply with the profitability and sustainability rules that they've already breached. What's on the horizon or already in progress is potential litigation against Everton to sue them for financial recompense from other clubs that have been relegated over the period in which they've been deemed to have cheated from a financial perspective. They weren't in compliance, according to the Premier League and its independent commission, with the profitability and sustainability rules, and other clubs complied during that time. Therefore, it could be argued they had a competitive advantage, and other clubs have lost out financially to the tune of hundreds of millions of pounds by being relegated from the Premier League. 6 clubs have come together to argue that case. And if each of those clubs were to be able to argue that they've lost £100 million, which could be easily argued with the difference between broadcasting revenue in the Premier League and the Championship, that would be £600 million. You could even divide that by 2, just to be prudent, and share £50 million per club to be compensated by Everton. That would simply put Everton out of business. They're already distressed. They already have a potential new shareholder that's loaning tens of million pounds to the club. Cash is an issue, so any further legal issues are going to be significant for Everton in particular, because they simply will not be able to afford them, both from a cash and an FFP perspective. The Premier League may be leaning on that topic when it comes to including those financial impacts in profitability and sustainability. That could be seen to be a double count, but the cash impact is going to be significant, and it could even impact the valuation and even the sales process altogether. And 777 Partners, being the only entity in the running for a potential takeover, could walk away. That could lead to administration or even liquidation for Everton Football Club, and that's the worst outcome for this whole trial. The points deduction is probably something that the club can live with, especially in this season and the timing of that points deduction. There's still time for Everton to get out of the bottom 3, and I suppose the odds could be argued that they are in their favour at this point in time. With the potential galvanising effect of what's happening, this could mean that the squad come together and start to really perform on the pitch as they've done so recently and get out of trouble from a relegation perspective. But is that going to be enough? And will it be the ripple effect that this case is going to have, being unprecedented, that will have a more significant and substantial effect on Everton Football Club? That's yet to be seen, but if the 777 Partners takeover does take place before the end of the calendar year, as we move into the January transfer window, it will be possible for Everton to look at its sister companies as part of the 777 Partners group to be able to loan players into Everton and potentially benefit from that, given the Premier League's recent decision to not ban related party loans or associated party loans in the January transfer window, which was supposed to be a temporary measure. So that definitely goes in Everton's favour, but for me, the financial ramifications of this go way beyond the 10-point ban. What are your thoughts on Everton's situation? This has definitely been a lengthy discussion, and we'd welcome your input. So please leave your thoughts in the comments below. If you like the video, if you have any value taken away from this video, please leave us a like, share it with your friends, and if you want to learn more about football finance related topics, please subscribe to our channel to support it. My name's Neil Wood and I'm a football finance professional. Thanks for watching, and we'll see you in the next one.